1 year from now, you're going to be a happy investor if you bought into a REIT. Of course, not any REIT. It's still a bold statement to make nonetheless, because it's as good as saying that the worst is over for Singapore REITs. It's as good as saying that the bottom has been in. Such a statement sometimes can go wrong, and if it goes wrong, it looks very silly. But I'm here to justify why I believe in it. Stay right to the very end, because I'll also be sharing with you where I've put my money towards. So if that's fair, let's go. Hi guys, welcome back. Let's start with Singapore's biggest REIT, CICT, Capital Integrated Commercial Trust. You would see right now that at current price is about 5.6% in terms of dividend yield. So I would like to use it to map out what has happened thus far and what to expect moving forward. The first red arrow downwards is actually in COVID, correct? Why did it crash? Quite simple. CICT owns malls. You may have been to Plaza Singapura, you may have been to Bugis Junction, or you may have worked in Raffles City itself. But during the COVID period, remember, there was lockdown and there was actually a rent-free period that government imposed on REITs. That is why the stock price actually crashed. But what you see next in the green arrow is that there was expectation of normalization, vaccination came about, and everything started to recover back to the good old days. This 1.5 year recovery persisted all the way to April 2022 before it moved into the downward orange zone. So take a guess, why did that transition happen? Quite simple, over here. April 2022 was the very first time the Fed actually increased its interest rates. And when interest rates increase, interest costs increase. And when interest costs increase, REITs who have loans have to pay more in terms of interest costs, and that eats into the net distributable income to shareholders. If you'd like to invest in Singapore REITs, I'd like to introduce to you today's sponsor, Moomoo. You can look for me there on Moomoo. This is my profile. And if you'd like to buy CICT, you can actually look for a ticker C38U, and you can see real-time quotes on the platform. Moomoo is quite possibly the cheapest brokerage for Singapore stocks right now with $0 in commissions, and right now they have a National Day campaign to rediscover Singapore stocks. I like that a lot because I cover Singapore stocks a lot on this channel. If you're an existing user of Moomoo, you will get to enjoy 1 year commission free for Singapore stocks. You will also get to enjoy the 5.8% per annum guaranteed yields from this Moomoo Cash Plus. On the other hand, if you are a new user today, look for referral links below because Moomoo has a new sign-up offer for you. Deposit $3,000 and perform 3 trades, you get a free C Limited share. And deposit $10,000 and perform 5 trades, you get 1 free Apple share. In total, there's $700 worth of welcome rewards. Check out this National Day campaign that Moomoo has, especially if you'd like to buy some of the REITs that I'll be covering with you on today's tutorial. Now let's move on to Suntec Reit, which is a close comparison to CICT because Suntec Reit also owns offices, it also owns malls. You may have also worked before in Suntec City. So again, we see the red arrow downwards, COVID crash, and the green upward slope, which is the recovery phase. Suntec Reit was actually one of the best recovery plays back in 2021 because it not only had offices which were fully occupied, it also has something which I've covered before, which is its exhibition hall kicker. Suntec Mall actually does a lot of exhibitions, baby fair, car fair, travel fair, you name it. I've even been to a popular fair that's held in Suntec City. Sidley's conference, which I've been a speaker to, is also in Suntec City. So conferences are its unique selling point and where it draws its crowd to give its mall business. As you can see, that peak also came in April 2022 and Suntec Reit's share price has came tumbling down ever since. So if you have been curious on Suntec Reit, let me give you 3 explaining points as to why this orange arrow is even steeper than CICT. The first is that Suntec Reit is more focused on offices than CICT, and offices have become a feared sector. Market has news that US offices are getting vacant. It is true, US office return rates are about 50+% only. But in Asia and especially in Singapore, everybody is kind of going back to offices nowadays already. Reports have suggested 80% occupancy for APAC offices, which is way healthier than North America. But if you drill down to data on Suntec City, you will see 100% occupancy. This goes to show Singapore offices are still booming. And when they are booming, you will see that Suntec Reit can actually collect more and more rent because there's full occupancy. The second point affecting Suntec Reit's share price is that it has assets in Australia and UK. Australian dollar and pounds have weakened significantly against Sing dollar. And to me, I think that's a small issue because currency, it goes up, it goes down, they go in cycles, and there will be a point whereby these two currencies actually recover against Sing dollar. The third and most damning point is that Suntec City has actually the least fixed loans back at the start of this rate hike cycle. Hindsight is 2020, and what we can see is that the unhedged risk of interest rates going up destroyed shareholders' value. And just to put numbers to things, at the start of the rate hike cycle, Suntec Reit only had about 50% of its loans fixed, and they had a lot of maturities in 2022, 2023, and even 2024. That's why the share price got punished. But then also, nobody expected this unprecedented rate hike cycle that's never been seen before. And that's why I've also called Suntec Reit quite possibly the cheapest REIT around a year ago. But now looking back, quite clearly it couldn't cope well with 500 basis points in terms of interest rate hikes. Right now, the financing cost is at 3.68%, which looks pretty ugly. If you see, there's a big jump quarter on quarter. Its interest coverage ratio is 2.2 times. That's among the lowest across all S-REITs, and that's below the 2.5 times benchmark. Personally, I don't quite know how to solve this also if I were in Suntec Reit's management. Some typical solutions will be to privatize it and reorganize. I hope also, as a shareholder, or Suntec Reit might need to sell shares via rights. I hope that doesn't happen because that will definitely destroy the share price even further. And last but not least, Suntec Reit might need to consider selling some of its assets to raise capital and bring down its debt. So coming to here, it seems that all REITs would die, correct, with interest costs so high now. But let me show you a different example. And this is actually Ascott Trust. Again, Ascott Trust tumbled in the red arrow over there because Ascott is in hospitality sector. They own hotels. And with COVID, there was no travel, hotels were all empty. But then Ascott went on a 2-year recovery cycle because travel started to ease up, correct? Europe started to ease first, US started to ease first, and Singapore eventually did so too. Then in April 2022, it also saw a peak in share price for near term and tumbled down slightly. But as you can see, the orange line suggests that it's kind of also recovered fully from that shock itself. The question then is why? Tourism in Singapore has recovered, but actually if you compare to 2019, it's kind of so-so only. Chinese tourists are still not back in flows. But in other countries, travel has actually recovered very well, in particular Japan. I don't know if you have also Facebook friends who have gone to Japan very recently. I've seen many, I think it's very popular, and Japan is not the only one. Europe has also seen strong tourist recovery. Ascott has hotels in Japan, US and Europe. And if you couple that to its better interest cost management, you would see that its interest cost is only 2.3%. Of course, this will step up when they do some of its refinancing. But all in all, its interest coverage ratio, 4.4 times, is very much healthier. So let's round up points. Interest cost does impact REITs and REIT sentiment quite possibly. It is true. But the next question to ask is that if interest rate hike cycle is over or is going to plateau at least for the next few quarters ahead, does that mean that REITs no longer need to face more pain? If you haven't seen headlines, Fed has left interest rates unchanged, although they have signaled that they could still raise it slightly for the next few quarters ahead. At least that to me sounds like worst case is just slightly more pain. And in good case, the pain could even subside. That's what I'd like to suggest. 1 year from now, you could be very happy if you are a REIT investor. If there's no more further pain, could we camp in some REITs that have good operations like Ascott? Because there's always light at the end of the tunnel, correct? As investors, we have to be optimistic. Yes, it's true that there could be recession coming, but again, we are nowhere near the peak in terms of tourist numbers, in terms of office expansions into data centers, offices, and industrial parks. So in my opinion, there could be still a lot of untapped room for growth. And that leads naturally to the next question. Which REITs to camp in, correct? Now let me first answer that by saying which REITs I wouldn't camp in. And this would be my own personal list. You would see over here that these are the 7 worst performing REITs that have lost big amounts on a 1-year share price performance. While it's true that some of them could be oversold, I do think that many of them have their assets permanently impaired. Again, that's my own personal opinion. But they do have certain similar traits. The first is that the sponsor for these REITs are relatively less known, as compared of course to CapitaLand and Mapletree. The second is that these REITs own majority, if not entire of their assets in foreign countries. They could be US offices, Indonesian malls or China properties. What's going on right there, we really have no clue, and some of them really have problems that are permanent. That's why personally I do think Ascott is still good for me. It's still one of my biggest positions. You may like CICT or Suntec. Suntec's pain may not be permanent. And if you were to see the overall S-REIT index, we will see that it's gone sideways for the last few years, correct? What if it's like this? The Singapore Property Index back in 2013 to 2017. If we were to focus only in this segment, we would see a 3.5 years bearish cycle where everything went sideways. And you could say that there was certainly no optimism in that sector. But fast forward to today, we would realize that Singapore properties have trended significantly upwards ever since 2017 April. So the common wisdom is, if the assets are not impaired and prices have trended sideways or declined over the last few years, real value will start to emerge. If you see the global REIT index is 1 year down, 1 year up. Red circled is actually down years. Green circled are up years. So REITs are more likely cyclical and they will have recovery years. But right now, prices are cheap because the upswing is not guaranteed. Nobody knows when is it coming for sure. Nobody is even sure what the trigger points are. But again, as long as the assets are sound, you have time to wait it out. Now at the start of the video, I did mention that I'll be sharing with you what I've exactly bought. And without further ado, let me show it to you. I've actually made more purchases to Mapletree Pan Asia Commercial Trust. I'm happy with VivoCity and Mapletree Business City assets. If you like to buy Mapletree Pan Asia Commercial Trust, look for ticker N2IU. And again, check out Moomoo's National Day campaign for Singapore stocks. I've made more purchases on Mapletree Industrial Trust because I'm happy with data centers at this current price. I put my money to where my mouth is, and I will be sharing an update on these two REITs pretty soon once they release their new results in the coming few weeks. So again, smash the subscribe and stay tuned for it when it's released. Thank you for watching right to the very end. If you haven't seen this previous tutorial I've done, which is why I've actually sold my HDB and I've actually used that funds to buy REITs, check that out also. It will give you some foundation insights as to how I've actually made my financial moves, and hopefully it could provide you some value too. With that, sign up from me and see you there. Take care as always. Goodbye.